Welcome back. You're watching Traders Corner, and joining me as always is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, we'll start off talking as we normally do about the S&P 500, which is a little bit more interesting than our own market, which though it has ticked higher, it's ticking is the operative word at the moment.
Yeah, it's ticking, grinding higher, but yes, the S&P 500 is moving up a lot more exciting than our market, I suppose, even if this is not that exciting. So the S&P 500 chart is up on the screen, and there you can see the significant development that I spoke about last week was the move through 2815. And last week I cited that little bull flag pattern and said it was beginning to break to the upside, and it looked like it was moving higher. And it does look as if we're going to go and retest that prior high from September last year, which is at 2940. It's not far away now. We're only about 45 points below that level, so it's less than 2% away. And I think it's probably just a matter of time before we go there, and possibly then even break to new highs, which is very surprising. I must say, I didn't think we would get there
so quickly.
Yeah, in more or less a straight line. I mean, we've had one or two little shallow pullbacks along the way, but for the most part, this market hasn't really given much of a pullback since the December lows. It's just continued to move north.
I mean, of course, I suppose the obvious trade this year would have been to go long the S&P 500 because things would be looking really swimming as far as the portfolio is concerned. So you must be beating yourself up a little bit.
Yeah, look, in hindsight, that's right. But a lot of us, and myself included, did expect that after that very deep sell-off in December, then you got quite a sharp bounce. You often would expect a bit of a double bottom or another retest of the low, or a partial retest of the low before it then bases and gets going. So to see it making such an aggressive V-shaped bottom like we've seen here has caught myself and many others by surprise. Yeah. But again, it's come about with a little bit of assistance, I suppose, from the Fed, with them now doing 180 degrees about turn in terms of their interest rate outlook. Back in late December, we were still looking at the possibility of maybe 3 interest rate hikes in the US this year. Now there's quite a lot of talk that we might even see a rate cut before the end of 2019. So it really has been an about turn in the way the Fed is addressing the market, and that's helped to propel this move in the S&P 500. And
as I said in the beginning, the JSE is sort of ticking along, but trade seems to have been quite boring in the last few days.
Yeah, especially the last 3 or 4 days, it's been very, very quiet, and the volumes have been incredibly thin. The top 40 index has really been trading in a range of about 300 points since about Thursday of last week. So it's very, very dull. But having said that, I mean, the overall technical structure here still does look fairly bullish. You can see that upward channel that's been intact since December is still very much in place. Market continues to make higher lows and higher highs. So whilst that is the case, we've got to continue to give the bullish outlook the benefit of the doubt. But yeah, certainly over the last 3 or 4 days, it's been very dull. And there's been no real corporate action or economic data domestically for the market to feed on. So it's been quiet, and the volumes have been very low. I mean, yesterday's volume, being Monday, it sort of rivaled that period between Christmas and New Year, where virtually nothing happens. So very, very thin volume been going through our market the last couple of days.
Yeah, which must be quite concerning for the JSE. Garth, so if we get on to some of the recent trades, and before we talk about the 2 stocks that you're looking at this week, Cap Industrial had a look at the chart before we went on air, and it looks like it's doing quite nicely.
It is. So the reason we went into this stock was because of a book build that had taken place last week, during the early part of last week. Steinhoff is continuing to sell down assets to try and bolster their balance sheet and try and fix up the mess that's been left behind. And one of the assets that they owned a 26% stake in was Cap Industrial. And they announced last week that they would do an accelerated book build in that stock that they own to exit that stake and thereby free up a whole bunch of cash. So they ended up selling down 26% of the shares in issue in Cap at a price of R6.85. And you can see the big gap to the downside on the chart there that was caused by that book build, that accelerated book build. The price we said was likely to sort of stick around the R7 level and probably wouldn't go much lower than that, and was gradually likely to recover some of the loss that we had seen following that book build. And that seems to be the case. We went long at R7.02 with a stop loss at R6.85, and we're looking at a target here of R7.40, which would essentially mean the share price has to go back up and cover that gap that was created by the book build. So it seems to be heading in the right direction. It is up a bit from the levels where we bought it, and it does appear as if there's appetite at the lower levels to keep taking this share price a bit higher.
It's a slightly sluggish trade, which is not ideal. I mean, we like trades to pan out immediately, but it's a week, so maybe we shouldn't be too impatient.
Yes, I think that's right. Also, keep in mind that with a situation like this, you've got a case where a whole bunch of stock was placed into the institutional market at R6.85. So there's a lot of new shareholders, but you'll also find that a lot of those new shareholders will tend to stag that opportunity. In other words, they got in at R6.85, they can now sell it out at R7.20 or thereabouts, lock in a nice quick profit. So you will tend to find that there's an element of selling as the price bumps up.
Okay.
But notwithstanding that, I still think that it looks good, and there's probably a good chance it's going to go up and effectively cover the gap that was created by that book build.
Yeah. Okay, so that was last week's trade. Let's look ahead to what you're doing this week, and it is finally some action on the international portfolio.
Yes, that's it. The international portfolio really has been quite neglected by me this year, and I've said repeatedly that I need to get going and do something there. So we've got two stocks that we're looking at this week. The one that I've actually done a trade in is Google, and that chart is up on the screen at the moment. And it's a bullish looking setup, as is the case with a lot of S&P 500 stocks, and particularly your tech stocks. You can see how the share price has been rising in this upward sloping channel since December of last year. What happened about 3 weeks back is the share price formed a falling wedge pattern within that overall upward trend. Typically that is viewed as a bullish continuation pattern, and usually it will break to the upside and continue higher. So we did flag this for our traderscorner.co.za subscribers last week and identified that the stock was looking to be moving higher out of the top of that falling wedge pattern. So for the portfolio this week, what I've done is I've gone long on the breakout above that wedge pattern at $1,183 per share. Stop loss is 1160, and I'm looking for a move back to the prior top, which is at 1230, but I think there's a good chance that it may even go beyond there. So if it gets to 1230, what I might then do is run a trailing stop loss below the prior day's low on part of the position, and then see if I can actually try and extract a little bit more out of it.
Yeah.
So it's a bullish setup. It ticks a lot of boxes for a long trade.
Are there any sort of other catalysts that one might look towards? When is Google, when do they report earnings?
Yeah, you'll find that a lot of your US companies will now report quarterly earnings now at the sort of from the middle to the latter part of April. So that's a possible catalyst, but that's not a specific reason I'm going into the trade. I'm more interested here in the technicals as I see them.
Yeah. Well, talk us through the mechanics, because it's also interesting to be buying a stock that is worth over $1,100, and I suppose that's when CFDs really come into their own.
Well, that's it. We can't afford to buy a lot of them because of the fact that it is quite a high-priced stock. So we're buying at $1,183. Stop loss is $1,160. So that means that we're risking $23 per share here. The risk that I'm assuming is $225, which is 1.5% of the capital that we have in our offshore portfolio. We have $15,000 at our disposal, so 1.5% of that is $225. As I always do, I take that capital risk and I divide it by the risk per share. So $225 divided by $23 per share gives us 9.78 shares that we could buy. So rounding that up, you can't do fractions of a share.
Yeah.
You buy 10 CFDs, which is what we've done for the portfolio this week. My target is $1,230, and that means that our risk to reward ratio here is 1 to 2, which is fine. I'm happy with that.
Yeah.
And potentially we could see a better risk to reward ratio if that target level is exceeded.
Yeah. I mean, does it ever give you pause and you think, geez, I'm only going to get 10 CFDs out of this?
You know what, it doesn't
sort of
really...
Psychologically more than anything else.
Yeah, it doesn't really bother me. Remember that we're talking about a stock here that's nearly $1,200 per share. So you work that back into rands, and you're talking about, nearly 16,000 Rand for one share.
Yeah.
So buying 10 of those, we're talking about 150,000 Rand market exposure. So the fact that it's only 10 CFDs or 10 shares doesn't really bother me. What's really critical, as always with all of our trades, is how much do we potentially lose if it goes wrong. And that's always the my main focus in terms of sizing the position.
Yeah, which is $225, which is
Yes.
a lot more palatable.
Yeah.
Garth, okay, so that is a trade that you've entered into. There's another stock that you're looking at, and that's Verizon
Yes.
Communications. Tell us a little bit about it.
Yeah, Verizon Communications, also S&P 500 stock listed in the US. And what I like about this one here also is the technicals. You can see that it's been in a nice steady upward trend since late January, consistently making higher lows and higher highs here. It's broken through an area of quite big resistance, which is at about $58 per share. You can see that indicated by that dotted line there. The fact that it broke out and now it's pulled back and retested that zone of support. It's a double support zone because it's the upward trend and it's also where all those prior tops come in. We have seen buying evident around the $58 per share mark, and over the last few days you can see long tails to the downside on those daily candlestick patterns, which implies that there are buyers evident at the lower levels. So what I'll be looking for this week, and quite possibly this evening when the show goes live and we are and the US market opens, I'll probably look to buy this at around about the current area, so somewhere around $59, maybe $59.20, more or less where it is at the moment. I'll look for a move back to the prior top, which is at $61. That'll be the minimum target with potentially a higher target, I think. And then my stop loss would be below 58. If it starts to take out those recent lows at 58, then I think we need to concede that this is not going to work.
Yeah.
But right now, that setup really does look good to me. Also notice that we've got positive reverse divergence on that stochastic oscillator at the bottom there, which is where your price is making higher lows, and yet your stochastic oscillator is making a lower low. So in other words, it's more oversold on this recent little dip than what it was on the previous dip. And usually it provides some sort of almost like a slingshot type of momentum where the share price moves to the upside. So I like this. I think it ticks a lot of boxes from a technical standpoint, and I think we can get a good risk to reward ratio on a potential trade here.
I mean, because you haven't, interestingly enough, you haven't really played around, should I say, with many of the tech stocks, specifically the US tech stocks.
Yeah.
I don't know if there's a bias against them, or if they just were so overbought last year that maybe it was...
Yeah, I think last year they were pretty overbought, and you did see them all coming down very hard in the final quarter of last year. But it seems as if they are now back in vogue. And in fact, in terms of the US sectoral performance, the tech stocks are outperforming everything else at the moment. So these types of shares, Verizon, Google, Apple, Amazon, Microsoft also, all of these are shares that we've been flagging on traderscorner.co.za as ones that look bullish with potential upside still.
Yeah, okay. So just to wrap up, what the portfolios look like?
All right, so our South African portfolio is looking a little bit better again this week. We're up almost 6% for the year to date, so that's not too bad 1 quarter into the year. And then offshore, we have now gone back to break even.
Okay.
This portfolio has been very inactive this year. We lost a bit of money on General Motors options earlier in the year, and now we're long of these Googles. And the Google CFDs are working for us at the moment. So we're practically flat on the year now for the offshore portfolio. But I'm encouraged by the trading action in Google, and I think Verizon looks interesting as well.
Yeah, okay. So that's to wrap it up. And then just a reminder that viewers can get a weekly alert from yourself.
Yeah, if you go to traderscorner.co.za and you look in the middle of the page there, you'll see a link to a free weekly email. If you enter your details there, we'll send you an email every Tuesday at lunchtime detailing exactly what is coming up on this show for the week ahead.
Great. Garth, we'll leave it there. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.